our webcast series for issues and developments related to the various accounting frameworks. Today's presentation is Bringing Clarity to an IFRS World, IFRS 15, Revenue from Contracts with Customers. I'm John Klickman, your host for today's webcast, and I'm joined by Maurice Vondet and Cindy Vino. Let's have a look at our agenda. First, you'll hear from Maurice Vondet, who'll provide us with some background on the revenue recognition standard, inform us of recent developments, and begin walking us through some of the proposed amendments. Next, we'll hear from Cindy Vino, who'll continue speaking to the proposed amendments, as well as sharing some insights on important considerations related to the implementation of the standard. We'll conclude with providing information on some resources for future reference and a brief question and answer session. Please keep in mind that we have a lot of material for a 90-minute webcast, so we'll need to keep the discussion at a fairly high level. I'd like to remind our viewers that our comments on this webcast represent our own personal views and don't constitute official interpretive accounting guidance from Deloitte. Before taking any action on any of these issues, it's always a good idea to check with a qualified advisor. I'd now like to welcome our speakers for this webcast. Maurice Vondet is a partner in our national office and is a co-leader of the Canadian IFRS Centre of Excellence. She's the national subject matter authority in the field of revenue recognition, as well as a member of Deloitte's Global Expert Advisory Panel on Revenue. Cindy Vino is a partner in Toronto and has over 20 years of public accounting experience with Deloitte in both Toronto and the United States. She has worked with clients on revenue recognition under different accounting frameworks over the last 15 years and is currently focused on working with clients in assessing the impact of the new revenue recognition standard. And with that, I will pass it over to Maurice.
Thanks, John. Good day to everybody online today. So before we get started on recent developments, we thought we would level set and provide some brief background information on IFRS 15. So as you know, the ISB and FASB issued a new converged revenue standard in May 2014 that replaces all existing revenue standards. And these standards have a broad scope. They address how to account for all contracts with customers across all industries, except those that are within the scope of certain other standards, as you can see on the right side of your screen here. So the revenue model does not apply to contracts within the scope of IS 17 lease contracts, IFRS 4 insurance contracts, contractual rights or obligations within the scope of other standards, primarily various types of financial instruments, and non-monetary exchanges whose purpose is to facilitate a sale to another party. Parties to collaborative arrangements, which are common in certain industries such as pharmaceuticals, biotechnology, oil and gas, for instance, may require assessment to determine whether they are in scope of IFRS 15 or not. So an entity would be required to assess the structure and the purpose of the arrangement to determine whether the transaction is for the sale of goods or services as part of the entity's normal business activities, and whether the counterparty represents a customer. And if that's the case, then the collaborative arrangement would be within the scope. Another item, transfers of assets that are not an output of the entity's ordinary activities, such as sales of non-financial assets, property, plant, and equipment, real estate, or intangible assets, would be within the scope of certain parts of the standard, specifically the guidance on determining the existence of a contract, measurement, and control principles would apply to those transfers to determine when and for what amount the asset should be derecognized. IFRS 15 also deals with incremental costs of obtaining a contract and costs incurred to fulfill a contract. So when should those costs be capitalized? And they provide guidance on amortization of those costs and how to test them for impairment. Finally, here, a contract with a customer may be partially within the scope of 15 and partially within the scope of other standards, like IS 17 for leases or IS 39, IFRS 9 for financial instruments. So IFRS 15 indicates how to assess which guidance to consider to separate these elements and initially measure each parts of those contracts. So the effective date has officially been deferred by 1 year to annual reporting periods beginning on or after January 1, 2018, including interim periods. So for a calendar year-end entity, they would apply the standard in their first interim period ended March 31st, 2018. Early application is permitted under IFRS 15 and is also permitted under US GAAP, but not earlier than the original effective date of Jan 1, 2017. The boards have provided a bit of relief by way of transition methods, and they've also proposed additional relief, as we'll see a bit later on in the presentation. An entity has the option to choose between two transition methods. So the first one, which I call the full retrospective approach, an entity would elect to apply the standard fully retrospectively, taking into account certain practical expedients. So in this case, they would restate, for instance, their beginning retained earnings at Jan 1, 2017. Certain expedients, as I mentioned, are currently available in IFRS 15 under the full retrospective method. And if any of those practical expedients are used, they need to be applied consistently to all reporting periods presented, and their use and likely effect must also be disclosed. So an entity could also elect to use a modified transition approach. In this case, they apply the revenue standard retrospectively to contracts that are not completed as of the date of initial application of the standard, which is Jan 1st, 2018, and recognize a cumulative catch-up without restating comparatives. This modified approach may reduce the cost and complexity of adopting the standard because it limits the assessment performed only to contracts that are not completed contracts prior to the year of adoption. But it also has certain drawbacks, as we'll discuss a bit later when we discuss the advantages and drawbacks of each approach later on in the presentation. So the standard supersedes all existing revenue standards and creates a single model for recognizing revenue. The core principle, as you can see here on the screen, is to recognize revenue to depict the transfer of promised goods or services to customers in an amount that reflects the consideration the entity expects to be entitled in exchange for those goods and services. And the model includes a 5-step approach for applying this principle. And that 5-step approach is not too unfamiliar for Canadian practitioners because it's close to what we've been applying in the past in terms of a 5-step approach. But it's really in the details of each of these steps that you'll see differences come up. So the first step is to identify the contract. So does an enforceable contract exist? Step 2 is to identify the performance obligations in the contract, which is similar to the notion of separating multiple element arrangements into accounting units. Step 3 is to determine the transaction price, and that's the amount the entity expects to be entitled to under the contract. Step 4 is to allocate the transaction price that we just determined under Step 3 to the various units of accounting. And finally, Step 5 is to recognize revenue when or as the performance obligations are satisfied, and that's when control of a good or service is transferred to the customer. So this is an important point under the new revenue recognition model. It is based on a control approach, which differs from the risks and rewards approach that's currently applicable under IFRS. The boards decided that an entity should assess the transfer of a good or service by considering when a customer obtains control of that good or service. And control is defined as the ability to direct the use of and obtain substantially all of the remaining benefits from the asset. So the ISB and FASB have created a joint transition resource group. And the purpose of the TRG is to solicit, analyze, discuss stakeholder issues arising from implementation of the standard, inform the boards about those implementation issues, which will help them to identify, what they need to do, any action that's needed to address those issues, provide a forum for stakeholders to learn about the new standard from others that are involved with implementation. So the TRG doesn't issue any guidance. And the members of the TRG include financial statement preparers, auditors, users representing a wide spectrum of industries and geographical locations. They also include public and private companies, as well as representatives from various organizations. And basically, any stakeholder can submit a potential implementation issue for discussion at TRG meetings. So far, the TRG has met 5 times. All the meetings are public, and they're co-chaired by the vice chairmen of the ISB and the FASB. And you can access the meeting papers, the summaries of the meetings, the submission tracker that lists all, all the issues and a summary of the issues and the current status of each of the issues that have been submitted. So as of July 2015, 75 issues had been submitted to the TRG, which resulted in 43 papers that have so far been discussed at the TRG. Out of those 75 issues, 36 issues had been discussed with no further action at this time. 15 issues had been submitted to the boards for further deliberations, which resulted in amendments or proposed amendments to the standard, as we'll see later. 8 issues are pending potential future discussions, and 13 issues are pending minutes of the July TRG. And the next meeting is scheduled for November 9th, 2015. So I like this timeline because it clearly demonstrates that a lot has happened since the standard was first issued in May 2014. As previously mentioned, there have been 5 TRG meetings, which are highlighted there in the blue boxes, which have resulted in issues being raised with the boards for further deliberation. And those are highlighted by the green boxes indicated FASB and ISB discussions have been held. The ISB has issued 1 ED of clarifications to IFRS 15 with a comment period ending October 28, 2015, which includes clarifications to identifying performance obligations, licensing and royalties, principal versus agent considerations, practical expedience. And the FASB, well, they have issued 3 proposed ASUs, as you can see here on the slides, which include more or less similar topics. Some of those for which the comment period has ended, and one of those, which is a proposed ASU on narrow scope improvements and practical expedience, the comment period ends November 16, 2015. So we'll be discussing these proposed amendments throughout the presentation today. This slide summarizes the topics included in each of the ISB and FASB proposals, and we can see here that the ISB does not propose for the time being to make amendments on certain topics that have been included in the FASB proposals. On certain of those, notably the last 3 topics that you can see here on the slide, sales taxes, non-cash consideration, and collectability, the ISB has included a question in their ED asking stakeholders whether they agree that amendments are not necessary at this time. If they think amendments are required, what are those amendments that they would suggest, and so on. The ISB has set a high hurdle for making changes to IFRS 15 and set out in the basis for conclusions the rationale for that decision. And so they clearly indicated that they wanted to minimize changes to the standard to the extent possible. And we'll get into some of those details on the next few slides. Of particular note here, the FASB finalized on October 5 their discussions on the proposed ASU on performance obligations and licensing. And they've instructed the staff to begin the balloting process so that we would expect a final ASU before the year is out. So let's kick off the discussion on the proposed amendments to step 2 on identifying performance obligations. So there's 3 here, and I'll discuss the first 2 issues. Determining whether promised goods and services are distinct in the context of the contract. So you may recall that IFRS 15 includes two criteria to determine whether a good or service is distinct. There's a first criteria that effectively acts as a floor, which is to determine whether the good or service is capable of being distinct. And that's similar to the standalone value test that you may be familiar with. And the other criteria is whether the good or service is distinct in the context of the contract. And that's a new requirement, and it's basically to ensure that the good or service retains its distinct characteristic in the context of the contract. So factors that indicate that a promised good or service is distinct in the context of the contract, there's three of them in the standard. The first one, the entity does not provide a significant service of integrating the good or service with others. The good or service does not significantly modify or customize another good or service. And the good or service is not highly dependent on or highly interrelated with other promised goods or services. So stakeholders indicated that it was unclear how to interpret these factors, particularly the last one on whether the goods or services are not highly dependent on or highly interrelated with other goods and services, noting that many such goods or services may be seen as being highly dependent on or highly interrelated with others. So the IASB decided to clarify the intent of the distinct criteria here by adding some examples and changing some of the existing examples, as well as improving the articulation and the basis for conclusions. However, the FASB also proposes to amend the standard itself. So as you can see here on the top right corner of your slide, the following decisions were made by the FASB: to define the term separately identifiable and explain that the objective there is to determine if the nature of the overall promise is to transfer each good or service individually or a combined item, to reframe the separation criteria to focus on a bundle of goods or services and if they significantly affect each other, and to reframe the factors to when they are not separately identifiable as opposed to when they are separately identifiable. So this is one example where, although the decisions are different in terms of how the standard is effectively amended, because they are intended to clarify the guidance and the boards agree on the outcomes of each of the examples, the IASB expects no difference in application. The other topic I want to discuss here is the one on shipping and handling services as a promised service or activity to fulfill other promises. So IFRS 15 focuses on transfer of control versus transfer of the risks and rewards of ownership, as we've mentioned before. There may be more situations where control of products has been transferred, although the entity may be responsible for subsequently shipping product. In these instances, revenue from the sale of product must be recognized before shipping occurs because control has transferred. But the question is, should revenue be deferred to cover the shipping and potential insurance obligation, or should costs be accrued for that obligation as a cost of fulfilling the contract? So IFRS 15 makes clear that it does not exempt an entity from accounting for promises that may be seen as perfunctory or inconsequential. Instead, an entity should assess whether the performance obligation is immaterial to its financial statements. So in the end, the IASB decided not to propose any changes in relation to shipping and handling, and the FASB, on the other hand, decided to offer a practical expedient, as you can see here on the right side of your slide. So here, in this case, there may be a difference in application if the boards go ahead with their standards as currently drafted. So let's now consider some examples. The first one here is from the IFRS 15 Clarifications Exposure Draft, and it helps to illustrate how to interpret the criteria of distinct in the context of the contract. So how to determine whether a good or service is a performance obligation on its own. So you have here company ABC. It enters into a contract with a customer to provide equipment and installation services. The equipment is functional without customization or modification, and the installation can be performed by other service providers. But the contract requires that company ABC is used for installation. So the question here is, what are the performance obligations in this contract? Are there two, the equipment and the installation, or only one, which is in fact the installed equipment? So the clarifications indicate that to make the assessment, one needs to evaluate the relationship between the goods and services in the context of fulfilling the contract with the customer. The objective being, are you delivering multiple things or a combined item to which the other things are inputs to create an item that is greater or substantially different than the sum of the parts? In this case, the contractual requirement to use the entity's installation services wouldn't change the entity's conclusion that its promises to transfer the equipment and to provide the installation are distinct. This is because the contractual agreement to use the entity's installation service doesn't change the characteristics of the goods or services themselves, nor does it change the entity's promises to the customer. In other words, the entity promised to deliver equipment and then install it. It hasn't promised to deliver an output that combines the equipment and the installation and transform those inputs into something that is different. The installation doesn't significantly modify or customize the equipment, and fulfilling the contract requires no significant integration or contract management service. So although there's a functional relationship between the equipment and the installation, the entity would still fulfill its promise to deliver the equipment without having to install it, and the entity could still fulfill the same installation service even if the customer had acquired the equipment from another entity. The clarifications exposure draft also introduced an example about the sale of equipment with a consumable like a printer and a cartridge, and also indicate here that although there's a functional relationship, the printer and the cartridge are distinct performance obligations. And we can contrast that with, let's say, another example, such as the construction of a building. There are many goods or services that are capable of being distinct when you think about a construction of a building, but in the context of the contract, those separate goods or services are inputs into a combined output, which is the building for which the customer contracted. So the separate goods or services lose their distinct characteristic in the context of the contract because they're transformed into something different that's greater or substantially different from the sum of the parts. Let's now look at a shipping service example. So in this example, we have entity A. It enters into a contract with customer B for goods that are shipped on cost, insurance, and freight basis. The terms are such that title passes once the goods cross the ship's rail, at which time the customer is obliged to pay for the goods, and entity A is responsible for freight as a principal. So cost, insurance, and freight is a trade term that's commonly used in international sea transportation, and that requires the seller to arrange for the carriage of goods to a port of destination. So the seller is responsible to pay the costs and freight to bring the goods to destination and arrange insurance during transport. So the question here is, identify the performance obligations. Is there only one, the sale of goods, or are there two, the sale of goods and then transporting the goods? So the solution here is that there are two. Entity A recognizes revenue on transfer of control of the goods when the goods pass the ship's rail, because at that time, the indicators of transfer of control have been met. So the entity transferred legal title, the customer has an obligation to pay, entity A presumably has not retained significant risks and rewards of ownership, for instance. And then freight services would represent a separate performance obligation, assuming that they're considered material, not immaterial in the context of the financial statements. And the transaction price is allocated to the freight services, is recognized as those services are performed. So this next slide here illustrates quite well how to deal with shipping and handling activities. So you can see here that if shipping and handling happens before transfer of control, then shipping and handling would be seen as a fulfillment activity, and no revenue would have to be deferred once control transfers for shipping and handling. However, costs may need to be accrued. And if shipping and handling happens after transfer of control, then it would potentially be a separate performance obligation to the extent it's not considered to be immaterial in the context of the financial statements under IFRS 15. However, you can see here to the right side under US GAAP, there would be an accounting policy election to treat these fulfillment, these shipping and handling services that occur after transfer of control as a fulfillment activity. So now I think I'll pass it over to John for the second polling question.
Okay, thanks, Maurice. Okay, here's our next polling question. Don't tell my boss, but I was streaming Game 4 of the American League Championship Series game at work, stayed home to watch Game 4. I'm not a baseball fan and therefore didn't watch the game, didn't even know the Blue Jays were in the playoffs. Evidently, they didn't even know they were in the playoffs, judging by the way they played yesterday. Click the circle that best reflects your response, and the system will automatically tabulate your votes. While we're waiting, here's a question for you, Maurice. I only see one more scheduled TRG meeting. Does that mean there will be no TRG going forward? And if so, how will issues be discussed going forward?
You're right, John. There's only one more scheduled meeting for 2015, which is November 9th, and we understand that the TRG doesn't currently have a meeting schedule for 2016. Most stakeholders are of the view that TRG should continue and both boards should continue to work together through implementation issues. And although the submission of issues has been winding down a little bit, there's still some issues that are being submitted and have yet to be discussed. So some entities have not even made real progress on their implementation yet, and there's some concern that additional issues may come to the forefront because of that. So in a nutshell, we think that there will be TRG meetings in 2016, maybe less, maybe half-day meetings, and we'll probably know more at the next TRG meeting on November 9th as to what they decide to do.
Okay, great. Thanks, Maurice. Okay, let's look at our polling results. Exactly 30% admit they were streaming Game 4 of the ALCS yesterday. 9% said they stayed home to watch. 59% said they did not watch or are not a baseball fan, and 3% say the Jays they didn't even know the Jays were in the playoffs. The correct answer, by the way, is did not watch the game. It will save you a lot of pain. Anyway, hopefully things will go a lot better this afternoon. Okay, speaking of intellectual property, I will now pass it over to Cindy for a discussion of the proposed changes to the license guidance.
Thanks, John, and hi, everyone. So we're going to switch gears a little bit, and we're still going to talk about proposed amendments, but we're going to start with talking about licenses of intellectual property. So just to level set in terms of the types of things that we're talking about when we talk about intellectual property, it could be the typical things that you would think of, like software, some kind of technology, but also things like movies, motion pictures, music, could be franchises, could be patents, trademarks. So there's quite a big collection of items that would fit within the definition of intellectual property and therefore would be subject to this guidance. We're going to talk about two issues with respect to licensing. The first one is basically how to recognize revenue from a license, and the second one relates to sales-based and usage-based royalties. So as Marie's mentioned, step 5 of the standard talks about how to recognize revenue. And with licenses, there is very specific guidance in the standard in terms of how you make that decision. And essentially, you're going to be recognizing revenue either over the license period or upfront at a point when the license actually begins and the customer has access to the product. but the guidance that you follow is not the over time versus point-in-time guidance in step 5 when you're dealing with a distinct license. And that's actually the first point. When we're going to go through this first issue, think about licenses where you've already made the determination in step 2 that your license is distinct. If your license is not distinct and you don't pass the distinct criteria that Maurice went through, then you do follow the normal guidance in step 5, which is determine whether revenue is recognized over time or at a point in time. But let's assume we're dealing with a distinct license. The concern that stakeholders had raised was that the guidance that was included in making this determination was difficult to apply. As I mentioned, there are still 2 methods of recognizing license revenue, and you have to assess the criteria of the license in order to determine what bucket you're in. And they use the terms either a right to access over time, which means revenue is recognized over time, or a right to use the intellectual property at a point in time. So both boards have made some proposed amendments, but they're different in this case. So we'll walk through the ISB decision and then tell you how it differs from where the FASB is at. So the ISB has said that the entity should really focus on whether an entity's activities significantly affect the intellectual property to determine the nature of the license. And they've said, take a look at the criteria that already exist in the standard, and we'll go through those in an example, and think about whether they change the form or function of the license, or they change the customer's ability to benefit from the value of the license. So the ISB has changed some of the language in the standard and also amended some of the examples. The FASB's made more extensive changes to the standard, and they've proposed that you have to characterize the nature of the license as either functional or symbolic. And there's a bit of a decision tree to go through. But basically, you know, if we talk about what I mentioned at the beginning of this slide, things that would often be functional are software and patents. Things that would often be symbolic are things like brands, team logos, trade names, things of that nature. And you categorize it as either symbolic or functional, and then you go through some additional tests to determine, or additional criteria to determine whether or not you recognize the revenue based on assessing that it's a right to access or it's a right to use at a point in time. And we'll go through an example of that. The second change that was made was related to when to recognize revenue for sales-based and usage-based royalties. So as you know, one of the big changes to in the standard in IFRS 15 is there's quite a bit of guidance on how to account for variable consideration. And in some cases, entities are going to have to estimate the variable consideration and allocate it to performance obligations, and in some cases recognize it before all of the uncertainty is resolved. But there's an exception in the standard in that when you have a sales-based or usage-based royalty related to intellectual property, you don't actually recognize it before the sale occurs or the license essentially is delivered. And so a question has arisen to say, well, what happens if I have a sales or usage-based royalty, but I have more than just an obligation to deliver the license? And so that in this case, the changes are the same, and the decision was made that an entity should not split a royalty when determining whether to apply the constraint exception, and that an entity should apply the royalty constraint exception if the license is the predominant feature to which the royalty relates. And both boards have added some paragraphs to the standard to clarify that. So essentially, if you determine that the license is the predominant item or feature to which the royalty relates, then you're going to recognize it based on the specific guidance that relates to sales and usage-based royalties for intellectual property. So we're going to go through an example of that right now. So if you can just go back one slide. So here we have an entity that is a movie distribution company, and it enters into a contract to license a movie to a customer who is an operator of cinemas for 6 weeks. And the total consideration the entity will receive is a portion of the operator's ticket sales for the movie. So that's the only consideration in this case that the movie distribution company is going to receive. And in addition to licensing the movie, The entity has also agreed to provide memorabilia for display at the customer's cinemas prior to the 6-week screening, and to sponsor radio advertisements for the movie on local radio stations throughout the 6-week screening period. So the question we would want to think about is, does the royalty constraint apply, and how is revenue recognized? So you saw a preview of the answer already, and in this case, the sales-based royalty constraint would apply, because if you think about this contract, the license to show the movie is the predominant item or performance obligation in the contract. And since it is a license of intellectual property that is the predominant feature, then you follow the sales-based or usage-based royalty constraint, which means in terms of when you recognize revenue, you recognize it at the later of when the subsequent sale or usage occurs. So in this case, that would be as tickets to movies are sold and the movies shown. And the other alternative is when the performance obligation to which some or all of the sales or usage-based royalty has been allocated has been satisfied. So in this case, the license to the movie has already been delivered, and so the actual later of would be the subsequent sale or usage. And so in this case, you aren't allocating any revenue to be recognized when the memorabilia is provided, and you're not recognizing, or you're not allocating any revenue separately to these radio advertisements either. So a second example that we'll go through is this concept of right to use versus right to access. So now we're talking about for the license as a whole that you've already determined is distinct. How are you going to recognize revenue? Are you going to recognize revenue when the license term begins and the intellectual property has been provided to the customer, or are you going to recognize revenue over the term? And in this example, we've got a creator of comic strips that licenses the use of the images and the names of the comic strip characters for a 4-year term. There are main characters in the comic strips whose images evolve over time, and new characters are periodically introduced. The customer can use the entity's characters in various ways, but the contract requires the customer to use the latest images of the characters. And in exchange for granting the license, the creator receives a fixed payment of $1 million in each year of the 4-year term. And so the question we have to ask is, what's the nature of the license? Because that's going to determine whether or not I'm going to recognize revenue as basically characterizing it as a point in time, so a right to use or a right to access. Okay, so if we just, right slide. So, so basically the criteria and the standard that you look at are listed on the right-hand side of the slide. And the 3 criteria to consider, the first one is, does the creator's activities, so in this case, changing the images of the characters, introducing new characters, does that change the form of the intellectual property to which the customer has rights? In this case, we would say that that's true. The second criteria is the rights granted by the license directly expose the customer to any positive or negative effects of subsequent activities. So in this case, the contract requires the customer to use the latest characters. And to the extent that something happened with that comic strip, then the customer would actually be exposed to positive or negative effects of the activities of the developer of the comic strip. And the third one is, even though the customer may benefit from those activities through the rights granted by the license, they do not transfer a good or service to the customer as those activities occur. So as the comic strip gets produced each day, there's no transfer of any good or service to the entity that has licensed the right to use the characters. But that does have an impact in terms of how, the benefit that the customer may derive from having licensed those characters. So in this case, we would conclude that the license is a right to access the intellectual property throughout the term, and therefore the license revenue would be recognized over time and not at a point in time. And with that, I'm going to turn it back to Maurice to take us through a couple more changes.
Okay, thanks, Cindy. So next changes we'll be discussing are changes to non-cash consideration and sales tax presentation. So more changes related to determining the transaction price, step 3. So the first item I want to discuss is determining the measurement date for non-cash consideration and application of the variable consideration constraint. So remember that IFRS 15 requires that in a revenue transaction, if you receive non-cash consideration, it must be measured at fair value. The stakeholders indicated that there were diverse views about the measurement date to use for promised consideration in a form other than cash. So examples that were brought up were shares or share options, advertising, or any other goods or services. As well, there were different interpretations of the guidance on how the variable consideration constraint would apply when the fair value of the consideration varies because of the form of the consideration. So for example, shares market price varies, and the form of the consideration is the share. And also for reasons other than the form of the consideration. For example, in the share option, the exercise price may vary because of the entity's performance. So the TRG discussed this in January, and three options were discussed for the measurement date to use for the non-cash consideration. The options were: should it be measured at inception, when the contract is first signed, and you know, we have an enforceable contract, when consideration is received or receivable, or when the performance obligations are satisfied if it's an earlier date. There's also two options that were considered for the constraint and how it applied, that the constraint, variable consideration constraint, applied to both the form or other than the form of the consideration, or only to variations other than the form of the consideration. So you'll see here that the IASB decision is not to propose any changes to IFRS 15 for this topic. Although the TRG members acknowledged that there was a lack of clarity around these questions, and the boards had instructed the staff to do some further research. They've noted that the issue had important interactions with other standards like, you know, the share-based payment standard IFRS 2 and IAS 21 on foreign exchange, and that, you know, any changes that they might likely make to IFRS 15 may result in unintended consequences. But they did ask stakeholders to comment on that decision in their ED on clarifications. But the FASB, on the other side, has decided to propose an amendment to require the measurement at contract inception. And the reasons that they noted were that it would be less costly, less complex, more in line with the notion of estimating the transaction price at contract inception and allocating the transaction price. So, and also on the constraint, they've decided that the constraint should only apply to variability resulting from reasons other than the form of the consideration. So variability resulting from the share price the constraint wouldn't apply. So here the decisions are different and will lead to divergence to the extent that an entity chooses under IFRSs to measure non-cash consideration other than at contract inception. And we'll see an example shortly of that. The other change that was discussed is simplifying the application of the sales tax presentation. So remember that IFRS 15 indicates that amounts collected on behalf of third parties, like sales taxes, for instance, should not be included in the transaction price. So entities are required, therefore, to identify and assess all their sales taxes and determine whether they should be included or excluded from the transaction price. Because many entities operate in multiple jurisdictions, some stakeholders raised concerns about doing this type of analysis for all taxes in all jurisdictions. And they also said that the analysis may be complicated by the fact that, you know, in certain jurisdictions, laws may be unclear as to which party is primarily obligated for the tax. So the FASB decided to propose a practical expedient to reduce the complexity that and therefore would allow entities to exclude from the transaction price all taxes that are assessed by a government authority and that is imposed on a revenue producing transaction and is collected from customers. Certain types of taxes would be excluded from the scope of the expedient. But the IASB decided against the change because of the lack of comparability that it may create, and also noting that entities currently have to do this work to some extent, and that disclosures would suffice and explain what the stakeholders have, what their accounting policy was. So again, here the decisions are different and likely to lead to diverse accounting. However, some say that the extent of divergence may not be so clear at this point in time. So let's look at an example of non-cash consideration that's currently included in IFRS 15 and also in the equivalent US standard. So an entity enters into a contract with a customer to provide a weekly service for 1 year. And assume the contract is signed January 1 and the work begins immediately. And in exchange for the service, the customer will promise to provide 100 shares of its common stock per week of service, so 5,200 shares in total. And the contract requires that the shares are paid upon the successful completion of each week of service. So every week, the entity will receive 100 shares over 1 year. And so the question is, in this case, how should the non-cash consideration be measured? So the entity will receive 100 shares every week for each week of service. The promised consideration is obviously non-cash, so we know it has to be measured at fair value based on the standard. What is the measurement date to be used? Should it be measured at contract inception, when consideration is received or receivable, or when the performance obligations are satisfied if it's earlier? Well, on the next slide, you'll see that we highlight two fact patterns. So under IFRS, in this case, the service is single performance obligation because the entity is providing a series of distinct services that are basically substantially the same, have the same pattern of transfer, and therefore the service will be recognized based on a time-based measure of progress. And so the entity would measure the fair value of 100 shares that are received upon completion of each weekly service period. And this is exactly in line with the illustrative example that is currently found in IFRS 15. So you see here that when they receive the first 100 shares, well, they will recognize revenue there based on the market price in week 1. When they receive the second batch of 100 shares, they will recognize based on the market price in week 2, and so on and so forth. Under US GAAP, the FASB board concluded that variable non-cash consideration should be valued at the contract inception date. So in this case, they've modified the illustrative example to measure the consideration at that date. So in this case, the 5,200 shares would be measured at the market price at contract inception. Under both frameworks, though, the entity does not reflect any subsequent changes in the fair value of the shares received or receivable in revenue. So obviously a difference there in application and could result, depending on facts and circumstances, in different accounting treatment. Another issue discussed at TRG and brought to the boards for deliberation is how to deal with collectability concerns on the next slide. Recall that IFRS 15 includes collectability as a criteria under step 1. The criteria says, it's probable that the entity will collect the consideration to which it's entitled in exchange for the goods and services that will be transferred to the customer. And it also indicates that that consideration may be less than the stated contract price if the entity will give a price concession. So the collectability threshold was introduced to ensure that the contract is valid, it represents a genuine transaction from an accounting perspective, and therefore if the threshold is met and all the other criteria are met, then you could apply the IFRS 15 requirements to that contract. If, however, collectability is not probable and consideration has been received, then the accounting treatment is punitive, or was considered to be punitive, because it would indicate that revenue cannot be recognized even on a cash basis, but rather only when either of the following events occurred. The entity had no remaining obligation to transfer goods or services to the customer, and all or substantially all of the consideration promised had been received and was not refundable, or alternatively, the contract had been terminated and the consideration received from the customer was non-refundable. So some stakeholders had interpreted the guidance to mean that an entity should always assess the probability of collecting all of the consideration promised in the contract. And therefore, contracts where probability of collection or the counterparty had credit risk would fail this criteria and would not represent genuine and valid transactions from an accounting perspective. So, you wouldn't be able to recognize revenue for those contracts until some other event occurred. Others indicate that these could be valid transactions nonetheless because the entity could protect itself from credit risk by requiring an advance payment, by stopping to provide future goods and services, etc. And that the collectability criterion should only apply to consideration to be received for goods and services that will be transferred to the customer. And that may not be all the promised goods and services if an entity can stop transferring goods and services if the customer defaults on payment. So in a nutshell, the IASB thinks that the guidance and the explanatory material and the basis for conclusions is sufficient and that entities would not need to consider probability of collection of consideration for goods and services that will not be transferred to the customer because the entity can stop performing. And again, the IASB asked stakeholders their opinion on this decision and whether they agree not to amend IFRS 15 at this time. The FASB, on the other hand, thought clarifications were required in the standard, as you can see on the slide here, and have added additional illustrative examples. So obviously here the decisions are different, but because the FASB's decision is intended to clarify the guidance and that the IASB sort of agrees or acknowledges that the answer is similar to what the FASB is proposing, the significant divergence is currently not expected. So we'll look at an example here. In this example, you have an entity that enters into a contract with the customer for the supply of a good, a modem, and the provision of service, internet service, for 3 years. The contract price is $460, and it's $100 payable at contract inception when the modem is transferred to the customer, and $10 payable at the end of each month for the next 3 years as the service is provided. And in the first month of the second year, the customer stops paying consideration when it is due. So the question is, how should revenue be recognized, and what if the entity stops providing the service to the customer? So let's look at 2 different situations. So assume at inception, the customer had good credit quality, which would normally be the case. So when there is an event of default, in this case where they stopped paying consideration, this may be an indication of a significant change in facts and circumstances that may lead to reassessing collectability of future consideration. So in this case, if the entity reassesses that collectability is no longer probable, but if it can stop performing in the event of non-payment, and let's say just provide a limited grace period, let's say 1 month, if you don't pay that last month, you'll be disconnected from service, then basically there would be no problem around collectability because the entity can stop performing. And therefore, collectability of what is expected to be transferred to the customer is still probable. However, if it was the other way around, that the entity could not stop performing, then it may no longer have a genuine contract and therefore would be required to stop recognizing revenue. Same situation if the entity customer had a low credit quality at inception. In that case, it received an advance payment for the modem, so there's no credit risk there. But the entity would have to assess history with this class of customer. And if that history demonstrates that the customer will pay consideration for 6 months, and after that the entity had a right to stop performing after a short grace period, let's say of a month or 2, then the entity would assess probability of collection of consideration for the goods or services that they expect will be transferred to the customer, which in this case would be the modem and the 6 months plus the grace period. So if they expect collectability to be probable for those that are expected to be transferred to the customer, then probability of collection is not a problem. So let's move on now to another issue brought up early on at the first TRG meeting in July 2014, which is gross versus net, principal versus agent considerations. The issue here, basically, as you know, is when another party is also involved in providing goods or services to a customer. So you're providing goods and services to a customer, but you're hiring a third party who is also involved in providing goods and services to your customer, IFRS 15 requires the entity to determine whether it is the principal in the transaction and should recognize revenue in the gross amount, or an agent and should recognize revenue for the fee or commission for arranging for the other party to provide the specified goods or services. IFRS 15 includes guidance to help an entity make that determination. Basically, IFRS 15 includes a presumption that if an entity controls a good or service before it is transferred to a customer, it is presumed to be a principal. And it includes, a number of indicators to help you make that determination. The TRG discussed a number of issues regarding this guidance, and some people question whether control was always the basis for determining whether an entity is a principal or an agent, and how the control principle and the indicators, which right now are indicated as indicators that an entity is an agent, how those things work together. Other people question how to apply the control principle to contracts that involve intangible goods like, online games and apps, website advertising space, e-tickets or vouchers, that type of thing, and how to apply the control principle also to services provided by others. So because of these discussions, the boards clarified the principal versus agent guidance quite a bit. And both boards are converged in the wording that they used to clarify their guidance, which is great in this case because they're harmonized. So basically, they've clarified that if an entity controls a specified good or service before that good or service is transferred to the customer, it is the principal in a transaction. And if the entity does not control the specified good or service before it is transferred to a customer, it is not a principal in the transaction with the customer. So that control is determinative. The indicators that an entity has control before it transfers a good or service were included to support an entity's assessment in scenarios for which that assessment might be difficult, and how those indicators tie to the concept of control. So the indicators don't override the assessment of control. They shouldn't be viewed in isolation. They don't constitute a separate or additional evaluation, and there shouldn't be considered a checklist of criteria to be met, but rather factors to be considered in all scenarios. And the indicators are helpful, and depending on the facts and circumstances, individual indicators will be more or less relevant or persuasive than others. The guidance also includes indications about when a specified good or service to be provided to the customer is a right to goods or services to be provided in the future by another entity, because in these cases it may be difficult to assess whether you control such right, and also indications of when a service is to be provided by another party. It may sometimes be difficult to assess when you control a service ahead of time. So basically, as I said, decisions are the same, and let's look at an example. So this example is where an entity engages a third party to render services on the entity's behalf. So entity enters into a contract with the customer to provide office maintenance services, and the customer is invoiced a fixed price on a monthly basis with 10-day payment terms. The entity then engages a third-party service provider to provide the office maintenance services. And again, here the payment terms are aligned with the customer's terms. However, the entity must pay regardless, the third-party service provider, regardless of whether they received payment from the customer. And so the question is the entity a principal or an agent? As I said before, it's a difficult assessment when we're talking about reselling services, because a service comes into existence only when it's delivered. But the entity needs to assess whether it controls the right to the specified service before it's transferred to the customer. So how would we go about making this determination? So on the next slide here, you'll see that the terms of the entity's contract with the service provider basically give the entity the ability to direct the service provider to provide the services on its behalf. In addition, when the entity considers the indicators in IFRS 15 that provide further evidence that the entity controls the office maintenance services before they are provided to the customer, they consider the entities primarily responsible for fulfilling the promise to provide office maintenance services. So although the entity has subcontracted the services to the service provider, the entity is responsible in the end for the acceptability of the services, regardless of whether the entity performs the service itself or engages a third party. The other indicator, the entity has discretion in setting the price for the services to the customer. So they've set the price independently of then renegotiating with the service provider. And the entity has credit risk. So although the entity does not have inventory risk in this case, because it doesn't commit to obtain the services from the service provider before obtaining a contract with the customer, it still concludes that it controls the office maintenance services before they're provided to the customer based on the other evidence. So this is an example in the clarifications ED. You need to be mindful of whether this may eventually change once they've redeliberated all the comments received. So I think that's it for me, John. I'll give it back to you, I believe, for polling question 3.
Okay, thanks a lot, Maurice. So here's polling question 3. Where are you in the process of adopting IFRS 15? We have not yet started thinking about the adoption process. We're starting to get acquainted with the new standard. We have done enough work to develop our implementation plan, or we are well into our implementation process. So while we're waiting for the results to tabulate, Maurice, there's a question for you. Are the illustrative examples that accompany the standard authoritative?
Yeah, that's a good question, John. So, if you look at the beginning of the illustrative examples, similar to, if you look at the beginning of the basis for conclusions, it states that these examples are the basis for conclusions accompany but are not part of IFRS 15. They say that the examples illustrate aspects of IFRS 15 but are not intended to provide interpretive guidance. However, this being said, there are more than 60 examples in the standard. And on many occasions, the ISB had decided to clarify the standard by changing the examples as opposed to amending the standard. So in my view, the examples are essential to correct understanding of the standard. And so I would expect that clients consider them before coming to their conclusions under IFRS 15 under similar facts and circumstances.
Okay, thank you. Let's see our polling results. So just under 60% or say they're starting to get acquainted with the new standard, and hopefully this webcast is helping in that respect. About 30% say they have not yet started thinking about the process. I guess hopefully they'll start to deal with that pretty soon. And we're into single digits in terms of those who've done enough work to develop our implementation process, and just 4% are well into the implementation process. As you'll hear from Cindy soon, the implementation process might be very heavy for your company. Okay, and with that, I will turn it over to Cindy.
Okay, thanks, John. Before we get into the heavy lifting, let's talk about some good news in terms of some practical expedients that are being proposed to be available on transition. So if we just think about transition, Maurice has talked about earlier in the presentation the 2 methods that you can use to adopt the new standard, either full retrospective or modified retrospective. So just remember the key word in there is retrospective. In both cases, you have to assess contracts that are not complete as of the date that you adopt the new standard. And in some cases, even contracts that you may think are complete. We'll get to that. So I think that's a really important point, because historically under Canadian GAAP, which is Part 5, which is the last time we had any significant revenue recognition changes, the standards were prospective to new agreements or contracts that were significantly modified. But this is really a standard that you're going to have to deal with from an inventorying perspective. So, if you're a retailer, maybe that is not a big impact, but if you're an entity that has long-term contracts, then this is going to be potentially a lot of work for you. And that's one of the reasons, when you think about when you're going to start to kind of dive in and get involved in understanding what the impacts are, Some of the companies that I've been working with are doing that now just because they have contracts that are long-term and they want to understand what the impact is to them for these contracts that they're signing now. So let's get started, and we're going to talk about two new practical expedients that are available on transition. And the first one relates to contract modification. So keeping in mind that the standard has to be applied retrospectively, and the fact that there's now very specific guidance on contract modifications, this is an issue without a practical expedient. So just as a reminder, when you modify a contract, depending on how you modify it with respect to changes in pricing and changes in performance obligations, you can either treat that modification as a separate contract. You can essentially account for the original contract as if you terminated it and you account for that and the modification together, or you could have a cumulative catch-up. So think about a contract that maybe it was signed in, even the late 90s that has been modified 2 or 3 times since then. Without any practical expedient, what you would be required to do is to go back and determine how that contract would have been accounted for in terms of the modifications on a sequential basis, because one modification can impact the accounting, and then another modification subsequent to that can have a different impact as compared to whether that was the first modification. So with all that being said, an entity, what's being proposed is that an entity is able to use hindsight as of the contract modification adjustment date. So we've got this new acronym, CMAD, and to perform a single analysis in terms of the impact of that contract under the new standard. And so the difference is when that date is. And so the IASB has defined the CMAD, or the contract modification adjustment date, as the beginning of the earliest period presented under both transition methods. And on the next slide, we'll illustrate that. That's different as compared to what the FASB's proposed, because they're saying that the CMAD date is the beginning of the earliest year presented upon initial adoption of the standard under the full retrospective method, and the beginning of the current period under the modified approach. So on the next slide, we have a handy timeline. So as we've talked about already, 2018 is the date of initial application. And let's assume right now that you have 1 year of comparative financial information. So if you do full retrospective, you're going to modify the numbers that you're presenting for the year ended in 2017, or the year ended, the year ended in 2017, and then you adopt the standard in 2018. And if you're applying modified retrospective, you're only doing your cumulative adjustment as at the beginning of 2018. And so in this case, we've assumed that there are 2 modifications. The contract begins in 2014 sometime. There's 1 contract modification in 2016, and there's 1 contract modification in 2018. And so from an IASB perspective, regardless of whether you're applying the full retrospective approach or the modified retrospective approach, what you don't separately evaluate are just modifications prior to January 1st, 2017. So, and that's a little bit confusing when you read the guidance. So you have to really go through it pretty carefully in terms of what's being proposed as a change. But essentially, the thought process is you don't want to wait and just look at amendments that are happening before the beginning of 2018, because that might not give you enough time to deal with the issue. So they said, let's look at modifications and use a cutoff date of January 1st, 2017. So if I had multiple modifications before the beginning of 2017, that's what I would be able to look at as one in one single area, versus in this particular circumstance, I look at that modification, and then I've got a new modification, modification 2, that I have to deal with separately. If I was applying the proposed practical expedient that the FASB has, I would have different outcomes, because they're saying the CMAD date is different depending on the full retrospective method or the modified retrospective method. We won't get into all of that granular detail, but I think the takeaway here is just to know that if you've got long-term contracts and if they've been modified, then you're going to have to be pretty careful in figuring out what the impacts are for your material revenue streams or your material contracts. The next practical expedient deals with completed contracts. So the IASB already had in its guidance the fact that if you were using the modified retrospective method, you would not have to deal with contracts that were completed before the date that you apply the standard. And now it's also come up with a practical expedient to enable you to exclude evaluation of any contract completed at the beginning of the earliest period presented when you're applying the full retrospective transition approach. So you can apply that concept in both scenarios, whether you're applying modified or full retrospective. The FASB, though, took a different tact. One, they changed the definition of completed contract, and we'll get to that in a minute. But the second thing is they're only permitting entities that apply the modified retrospective method to use this practical expedient, and they can do it to all contracts or only contracts not completed as at the initial application date. So let's just think about what this might mean. So from a FASB perspective, if you have a contract that was completed, let's say in 2016, but under the new standard, maybe it wouldn't be considered complete because you wouldn't have recognized all the revenue. You're going to have to figure out how to come up and look at that population of contracts, which I think is going to be really, really tricky in terms of finding those if you have complicated contracts. So that's just something to think about if you have to follow if you're following US GAAP. So now let's just take a look at the differences in definitions. So the IFRS definition of what a completed contract is a contract for which the entity has transferred all of the goods or services identified in accordance with IS 11 or IS 18. And this was also the definition that was provided in ASC 606, which was the original standard issued under US GAAP when it was first issued in 2014. But the FASB's changed that definition, and their proposal is a completed contract is a contract for which all or substantially all of the revenue was recognized in accordance with revenue guidance that is in effect before the initial date of application. So for those of you where you recognize revenue at the same time that you transfer goods and services, the difference in definition isn't really going to be a big deal, but there can be situations where it's going to make a difference. So for example, if you have a license with a future royalty stream, and let's say under current GAAP, revenue is being recognized as the royalties are being reported, but the entity has delivered the license. So from an IFRS perspective, the contract would be considered complete because the license has been delivered. But from a US GAAP perspective, the contract would not be complete. So it changes a little bit what you consider in and out of scope. And it also leaves open a question as to, under IFRS, what do you do with that revenue that has not yet been recognized, but the contract is actually considered complete? So once you get into the granularity of making some decisions on this, I think it's really important to make sure you scope the population of contracts that are going to cross over the transition date or the first application date, so you're clear on what you have to dive into in terms of assessing the impact. So we just want to talk for a couple minutes about what the advantages and disadvantages are with respect to the full retrospective method and the modified retrospective method. I would say a year ago or so, maybe even 18 months ago, as I was talking to companies about the standard, most of them were saying that they were going to apply full retrospective method. That was their desire. And I think that came from the fact that the entities that started working on this implementation, years ago, are the entities that are going to be significantly impacted by it. So, the telcos certainly have been working on this for a number of years, and it totally makes sense that they would be thinking about applying the retrospective method, because otherwise they're not going to be able to tell the user what the trends are in terms of the impact of this statement, and they may end up with revenue that never gets recognized in any period if they use the modified retrospective method. Now I'm finding that people are more looking to explore the modified method, and it could be because it provides a little bit more time, and it could be because it's if you're not going to have significant impacts in terms of timing or measurement in terms of recognizing revenue under the new standard, then it may not matter in terms of having such clarity with respect to prior period revenue versus current period revenue. Some other advantages, just with respect to the population of contracts that you may have to look to, that could be larger if you're doing full retrospective method. We talked about the trends for stakeholders. I guess the harder part with retrospective is, the potential issue with obtaining historical information and the disclosure that's required. One of the disadvantages on the modified retrospective method is in the year of transition, you have to disclose what your revenue would have been if you'd continue to apply existing GAAP. So you're going to have to run parallel regardless. It's just a question as to whether you do it before you implement before you start to disclose actually the information resulting from the application of the standard or after the fact. And I guess my last point on this is I would say my advice is don't make this decision too early. So a lot of clients want to make this decision as one of the first decisions that they make, but really I think you have to understand what the impact will be to your company before you make this decision. So are you going to have significant impacts related to timing of recognition? And if you applied modified retrospective, would you have revenue that kind of falls into a black hole and never gets recognized under the old guidance or the new guidance? So let's move on to implementing IFRS 15. And as John mentioned, it can be a pretty significant project for some entities. For some entities, it'll be a process of analysis and documentation to find out that there's not going to be an impact on timing of recognition, but there may be a significant impact on disclosure. So that's really what we've been talking about so far is, what's going to change with respect to timing, presentation, and disclosure. But there are many other aspects to it, and today we're going to talk a little bit about processes and controls and also information technology. But in coming up with an implementation plan, certainly there are other things to consider, such as tax, people, both the people involved in doing the accounting, the people involved in processes and controls, in systems, people that are on commission structures where their commissions may change if they're tied to accounting, folks in the sales function, in the legal function, and the marketing function, because you want to ensure that they are up to speed with respect to understanding the impact of the new standard. And finally, all the various stakeholders. So, you've got senior management, audit committee, boards, investors, bankers, looking at how your bank covenants are calculated. If you're going to have a significant impact in terms of timing and recognition, is that going to have an impact on how your covenants are calculated? So lots to think about there. So let's just touch on processes and controls for a few minutes. And you could take the standard and pull out every implication of the standard and determine what processes are going to have to change, if any, or what controls are going to have to be put in place. So for purposes of illustration, we just picked out three different items. And the first one I'm going to talk about is combining contracts, contract combinations, or contract modifications. So the standard has some specific guidance now on when you have to combine a contract and assess that group of contracts as one. And also we talked a little bit about modifications. So, I think one thing to think about with contract combinations is how are you going to decide which contracts actually need to be monitored for combination? So if you're a retailer, probably you're going to think that the timeline is, in most cases going to be relatively short. But if you're an entity where it takes 3 or 6 months or a year to negotiate a contract, what process do you have in place to identify those contracts that are signed with the same counterparty and assess whether or not they should be combined for purposes of the standard? And what controls are you going to put in place to ensure that your processes are working properly and are preventing errors or detecting errors? And if we can just go forward one more slide. And then with respect to modifications, again, since there are so many different ways to account for modifications now that you have to analyze, you need to think about processes for tracking modifications. You might even have some processes for assessing what types of modifications are now permitted, identifying them, and actually analyzing them so that they get reflected appropriately in your financial statements. The next area we'll touch on are material rights. So the standard includes a requirement to account for a material right, and a material right is essentially when the customer is paying for something now that relates to an option in the future. So they can include things like loyalty programs. So, if you walk into a drugstore and you use your loyalty card, The theory being that you're paying not only for the goods that you're buying, but also for those points that entitled you to something in the future once you accumulate enough points. The contract can have right in it an option to purchase goods or services at some kind of incremental or significant discount. Maybe there's an option to extend the contract at a lower price. Or maybe you have a situation where there's a non-refundable upfront fee that's paid upfront, and that actually enables someone to kind of renew a contract at a consistent price, but not pay that upfront non-refundable fee again. And so the challenges are firstly identifying these, secondly valuing them. So you only are looking at valuing the incremental discount to what anybody else could get if they just walked in and negotiated a contract with you for that good or service that's going to be delivered in the future. And you also take into consideration the likelihood of exercise. So these are some pretty big challenges in terms of how you're going to come up with a valuation process that makes sense in terms of implementing the standard. And also then you have to track when the options are exercised or when they expire in terms of recognizing the amount that was allocated to them. And that doesn't even get into some of the questions that have been raised as to whether, when you actually exercise this option, is that a contract modification or not? And can some of these material rights end up in resulting in significant financing? So just a lot of things to think about, that once you get the accounting solved, you actually have to do a lot of work to figure out what processes need to change and then what controls need to be in place. And the last one that I'm going to touch on is disclosures. So we haven't talked a lot about disclosures yet, but you've probably heard that there are a significant number of new disclosures that are going to be required under the standard. And there are a significant number of both qualitative disclosures and quantitative disclosures. And for purposes of thinking about processes and controls, I've just listed on this slide a number of the quantitative disclosures that are going to be required. So the first one is disaggregation of data. You're supposed to disaggregate your revenue in order to inform the reader about the nature, amount, timing, and uncertainty of your revenue stream. So that that could be caused by economic factors, and that may relate to the contracts or the business, the geographic areas that you operate in. The uncertainty or differences in uncertainty could relate to the duration of your contracts. Economic factors could have an impact related to the nature of the markets that you're in or the type of customer. So this may actually require you to assemble data from sources that you previously haven't done before. So that can take a lot of time and effort with respect to processes and controls. The second item here is that you have to disclose the transaction price that's allocated to remaining performance obligations. So let's say you have a contract and you are delivering, let's say 3 different items, and you've only delivered, and they're all distinct, and you've only delivered the first one by the end of the first year. You have to disclose the price that's been allocated to the remaining performance obligations. It's sort of like a backlog concept, and a number of clients that we've talked to really don't have the contract databases in place in order to pull that information and aggregate it in order to disclose it. There's a number of other ones that you have to disclose that I've listed here, and that's just a sample of what's in the standard. So lots of areas where you are going to have to put new processes and controls, or at least consider what needs to be put in place in terms of applying and implementing the new standard. And then I'm just going to touch on technology considerations for a couple minutes. And we just wanted to give you a brief overview of what's out there. So in terms of what's available from an information technology perspective, certainly the ERP vendors are coming out with, or have already come out with, solutions. So SAP, Oracle, NetSuite all have modules that are addressing this new revenue recognition standard. I'll say addressing loosely because it's going to be, it's going to be dependent on the solution in terms of how far that module is going to take you. Then there are specialty solutions. So vendors like Leo and RevStream, Microgen, SoftTrax have what we call bolt-ons that are out there that are also have been designed taking into consideration the requirements of the new standard. And then you could certainly get into customized solutions, although those usually take a long time to develop and they can have a higher cost of ownership. What's not on here is Excel. That certainly may be a solution for some of you, depending on the number of contracts that you have and the implications of the standard, but that comes with its own set of issues. In terms of deciding what's right for you, on this next slide, we just have some consideration points. So, you know, what incremental data are you going to need to collect, and what's the best way to come up with that data? You know, is there a solution that caters to or specializes in your particular industry that you want to think about? Can the current process be readily scaled or automated to reduce overall process risk? You know, do you need to integrate? So if you think about the telcos, right, they've got to integrate this engine or whatever they're going to use as their solution with their billing systems, and many of you may have the same issue. And then thinking about other technology type issues like, you know, do you want it to be hosted or not? And then the final point on information technology consideration is just that there are a number of things out there to help you in making this decision. So, you know, learning from others who have already made this decision, looking at some accelerator tools. So, and when I say accelerator tools, it's, you know, leveraging off of others who have come to accounting positions, understanding what's out there in terms of industry guidance or industry interpretations to think about. And then external expertise, right? Looking at, you know, what people are using in different geographies, taking part in roundtables or things of that nature. And the final slide that I'm going to speak to is just how do you get started? So from the slide or from the poll that, the last poll that we did, it sounded like there are a fair number of you that are getting acquainted and with the standard and are not quite at the point where you've been able to develop an implementation plan. So I think where to start is really to scope the impact of the standard. So, you know, when we're talking to companies, the first point I make is like, let's figure out what your total revenue is now and determine what's in and what's out. So that would be the first step. And I would say almost every entity that I've talked to is going to have some revenue streams that are going to be impacted by this new standard. So, you know, I wouldn't assume that you're not impacted before you do that analysis. And then I would start with a short-term plan to assess the key impacts and to use that to prepare an implementation plan. So, you know, review a sample of contracts, figure out for those contracts, what's the impact going to be to your financial statements. And I would also start identifying the disclosures that are going to require new data elements to be collected. And then you can, I think, we'll have a basis to start estimating the level of effort required to implement the standard and to think about, you know, who needs to be involved in your steering committee. How are you going to proceed? Are you going to have a decentralized approach? Is that how your organization operates? How are you going to drive consistency through the implementation? There are, I think, a lot of things to think about as you get going on this. Decisions, certainly accounting policies, choices, and significant judgments. The transition method we talked about, contract versus portfolio approach. So we didn't talk about that today, but there is an ability to look at groups of contracts as a portfolio if they meet certain criteria, which may be helpful to some of you. And then finally, starting early on your systems approach. So I know 2018 sounds a long way away, but if you have to implement a system change, I think most people would think that there really isn't that much time before you get started on the system side of things. And John, I will turn it back to you.
Okay, thanks a lot, Cindy. On the slide in front of you, you'll see a list of resources that'll help you understand and transition to the new standard. The list at the top are the Deloitte resources, and you'll see some additional resources near the bottom of the slide. On the next slide, you can see the list of our experts across the country who you can contact, and they'll be happy to assist you in dealing with the standard. If you have any questions or issues related to the standard, please reach out to your Deloitte partner or Deloitte contact, and they'll be happy to help you with any questions or concerns that you might have. We have time for one question here for Maurice, and the question is, if the FASB has provided specific guidance and the IASB hasn't, can IFRS preparers turn to the guidance issued under US GAAP?
Yes, John. So I was actually expecting this question. I thought somebody would ask it. So the boards have issued a converged standard and are making clarifications to the respective standards in different ways. And so although some may say that even even if there's different words, you would expect the same outcome. I think this may be very difficult in practice. So if the boards agree on an outcome, we would, it'd be most helpful if they said such and they'd use harmonized words. And if they disagree on an outcome, it should be made clear in the respective standards as well. So I guess what I'm saying is that I would hope that the boards work together to finalize the respective standards and that take this into account. Nevertheless, if the boards do indicate that, they expect that they should come to the same outcome, if the words are slightly different and there's some helpful words in the U.S. standard, then I don't see how we could preclude a client from looking at those words. But where it's clear that there's a difference, for example, we talked about non-cash consideration being one, additional practical expedients being others, licensing, and there's many more, then I don't think it would be appropriate to look to U.S. GAAP guidance in those cases. So I hope that's helpful.
Yes, it is. Thanks. Thanks, Marie. Appreciate that. Okay, we're coming to the end of the 90 minutes now. So I'd like to thank our speakers today, Maurice Vondet and Cindy Vino. Also thanks to our behind-the-scenes team, Alexia Donahue, Elise Beckles, Alan Kirkpatrick, Nura Taif, and Evan Dang. We hope you found this webcast helpful and informative. If you'd like additional information, please visit our website, Deloitte Canada Centre for Financial Reporting. And to all of you viewing our webcast today, thank you for joining us. This concludes our webcast, bringing clarity to an IFRS world, IFRS 15, Revenue from Contracts with Customers.